Your cloud bill is about to change forever, and you're betting on the wrong companies. Blackstone just armed Google with $100 billion for AI data centers. The ripple hits your finances in months. I'll show you the one sector that wins. Most people still think the AI cloud race is a two-horse show between AWS and Azure. That assumption just got torched. Google and Blackstone are creating a standalone company to build and operate hyperscale AI data centers, a $100 billion bet that reshapes the entire landscape. The reason is simple: training the next generation of models requires infrastructure on a scale never seen before. We're not talking about rows of servers, we're talking about power plants, land acquisitions, and supply chains that rival the military. Traditional tech balance sheets can't stomach it alone. So Google is bringing in the biggest landlord on earth to foot the bill. And this isn't just a lease deal. It's a structural shift in who owns AI. But here's what nobody's asking yet. Blackstone isn't just providing cash. They're providing a financial escape hatch. By offloading these massive costs into a separate entity, Google shields its earnings from brutal infrastructure depreciation. Think of it as a special-purpose vehicle for AI factories. Blackstone uses pension fund money, life insurance premiums, patient capital, to build the physical layer, while Google supplies the chips, the software, and the AI brain. The new company will sell computing capacity back to Google and other clients. This means Google can scale AI faster than any rival without tanking its profit margins. It's like having your cake and eating it too. Access to unlimited compute without the balance sheet nightmare. But the real kicker is who else might buy in, and what that means for the power dynamic. That's next. Here's the proof of concept. Last year, Microsoft partnered with BlackRock on a $30 billion AI infrastructure fund. It was hailed as a game changer. Now, Google has gone to Blackstone, the largest alternative asset manager with over $1 trillion in assets, and aims for more than triple the scale. That's not incremental, that's a declaration of war. Blackstone already owns QTS, one of the biggest data center operators, and they've been quietly hoarding land near key energy hubs. This venture gives them a guaranteed anchor tenant, Google, which is racing to deploy its custom TPU chips and catch up in cloud market share. The structure mirrors the cell tower model, where companies like American Tower own the physical masts and lease capacity to carriers. And that model turned out to be a cash-printing machine. But Google's play has a twist. So, what should you actually do with this? If you're an investor, stop obsessing over Nvidia. The next trillion-dollar opportunities are in energy infrastructure, cooling technology, and even boring companies that pour concrete for data centers. For entrepreneurs, this signals that AI compute will become a commodity faster than expected. That means your startup's moat can't be "we have a big GPU cluster." It has to be proprietary data or distribution. For the average person, your cloud subscriptions might get cheaper, but your data might get more concentrated. And here's a direct play. Look at utility companies serving regions like Ohio, Virginia, and Texas. They're about to see a surge in industrial electricity demand that's not priced into their stocks yet. But let's talk about the elephant in the room: overbuild. History is littered with infrastructure bubbles, from railway manias to the dot-com fiber glut. If AI demand plateaus or the efficiency of models improves dramatically, like DeepSeek's breakthroughs, then these $100 billion facilities become white elephants. Blackstone's structure protects them. They'll lock Google into long-term take-or-pay contracts. But what if Google's cloud growth stalls? Or if regulatory hurdles delay these projects? The biggest risk is that this JV becomes too big to fail, and we all end up paying for it through higher cloud prices or taxpayer bailouts if the energy grid can't handle it. And speaking of the grid, the energy angle is where things get really dicey. What comes next is a complete reordering of who controls AI's physical backbone. Sovereign wealth funds from the Middle East and Asia are already piling in. Expect countries to treat data centers like strategic oil reserves. Meanwhile, Google isn't stopping here. They're likely planning similar vehicles with other capital partners in Europe and Asia, creating a global network that's not on their books. The endgame? A future where AI is a utility, and the cloud providers are just software layers on top of privately financed infrastructure. The companies that own the steel and the power will hold the real leverage. And the first shots in this new war have already been fired. You just watched the opening salvo. Subscribe and hit the bell to stay ahead of these infrastructure land grabs before Wall Street wakes up.